ahead, Matt.
All right, so can you guys hear me? All right, perfect. Okay, so first up on the list is Benjamin Graham, also known as the father of value investing. He was actually an influential investor who's had quite a lot of experience in his lifetime. And his research in securities pretty much outlined the importance of fundamental valuation used in stock analysis today by virtually all investors. His famous book, The Intelligent Investor, which you guys know of, has gained recognition as the Bible of value investing. So while researching Benjamin Graham, one of the quotes I particularly liked was this: "You must never delude yourself into thinking that you're investing when you're speculating." For those of you who've attended our last guest speaker meeting, it's just like how Mr. David Ogburn said that young investors make the mistake of not distinguishing between speculation versus investing. And this is so crucial to understanding and is super relevant now that trading stocks are easily accessible than it was 100 years ago. So it's important to do your research. Now, I took a bunch of notes since there's a lot to cover. Graham was born in 1894 in London before moving to America with his family. His family actually lost their savings during the bank panic of 1907. So he was already introduced to the effects of the economy at an early age. Side note, if the bank panic of 1907 sounds familiar, that is because this global financial crisis actually inspired the monetary reform movement and led to the creation of the Federal Reserve System. Graham later went to Columbia with scholars and earned a $500,000 annual job on Wall Street upon graduation. That's pretty good. Um, it wasn't until the stock market crash of 1929 where Graham lost almost all of his investments. Just like how we learn from our mistakes, this event taught him some valuable lessons about investing. And these valuable lessons were so important to him that he was inspired to write about it with his good friends Irving Kahn and David Dodd. That is not related to the Dodd-Frank Act because that's actually the 21st century. But this book, published 5 years later in 1934, at the start of the Great Depression, was called Security Analysis. That's actually his first publication. And essentially, this book laid the fundamental groundwork for value investing, which we talked about earlier this year. If you need a refresher of what value investing is, value investing involves buying undervalued stocks with the potential to grow over time. Believe it or not, at the time, the stock market was low-key like Wall Street bets, where there was a lot of speculation. So this notion of value, margin of safety introduced in security analysis pretty much paved the way for fundamental analysis, which we also talked about earlier this year. Now let's talk more about value investing. According to Graham and Dodd, value investing is deriving the intrinsic value of a common stock independent of its market price. By using a company's factors such as its assets, earnings, and dividend payouts, the intrinsic value of a stock can be found and compared to its market value. If the intrinsic value is more than its current price, the investor should obviously buy and hold until a mean reversion occurs. A mean reversion is essentially the theory that over time, the market price and intrinsic will converge towards each other until the stock price reflects its true value. Now, by buying an undervalued stock, the investor is, in effect, paying less for it at a discount and should sell when the price is trading at its intrinsic worth. Macroeconomic students, ceteris paribus, the effect of the price convergence is only bound to happen in an efficient market. Value invest is rendered useless if markets were inefficient because there is no price correction despite the irrationality of investors in the market. Now, due to the irrationality of investors along with the other factors of unpredictability and price fluctuation, Graham noted that buying undervalued stocks can provide a margin of safety. Additionally, investors can achieve a margin of safety by purchasing stock in companies with high dividend yields and diversifying their portfolio, for instance. In the event that a company goes bankrupt, the margin of safety would mitigate the losses that the investor would have. This is why we officers stress the importance of diversification throughout the year. Diversification is key when crafting your portfolio. So hopefully you guys did that in your stock market game or your own personal portfolios in real life. Graham normally bought stocks trading at 2/3 of their net value as his margin of safety cushion. He also had like a fancy formula named after him for finding the intrinsic value of the stock that you can search up. Now onto Graham's most notable work, Investor, featuring a new forward from John C. Bogle. Bogle is another investor that Cassie will talk about later. But in this book, Graham writes about this character called Mr. Market, who is a metaphor for the mechanics of market prices. Mr. Market is an investor's imaginary business partner who offers to buy or sell shares. Mr. Market is often irrational, and he will go up to the investor's door with different prices on different days, depending on how optimistic or pessimistic his mood is. The investor is not obligated to accept any of Mr. Market's offers. However, this is the important part, guys. Graham notes that instead of relying on the daily market sentiments, which are often driven by greed and fear, which we can see in today's markets with Wall Street bets, the investor should rely on his own research and analysis of the intrinsic value of the companies offered at hand. And this analysis should, in turn, strengthen the investor's analysis, making them intelligent. The intelligent investor is one who sells to optimists and buys from pessimists. They look out for opportunities to buy low and sell high due to the price value fluctuations that arise from economic depressions, market crashes, human errors, etc., etc. Um, you may be wondering, how is this any different from his first book, Security Analysis? Well, while echoing the fundamentals introduced in Security Analysis, the intelligent investor also provides new key lessons to readers and investors by advising investors not to follow the herd, to hold a portfolio of 50% stocks, 50% bond or cash, to be wary of day trading, to take advantage of market fluctuations, to not buy stocks simply because it is liked, to understand the market volatility is a given and that can be used to an investor's advantage, and to look out for creative accounting techniques that companies use to make their EPS value more attractive. With that being said, although Graham died in 1976, his work lives on and is still widely used today by investors looking into a company's prospect for value and growth. Oh, and one more thing. Warren Buffett was Graham's protege, which you probably knew already. That's it.
So now we'll be talking about Thomas Rowe Price. So looking at this quote here, he once said, "It is better to be early than too late in recognizing the passing of one era. The waning of old investment favors the advent of a new era, affording new opportunities for the investor." So this kind of sums up his investment philosophy, as he was kind of known as the father of growth investing. And similar to Benjamin Graham, he kind of relied on fundamental analysis as well. So just as a refresher, growth investing is a style of investment strategy focused on capital appreciation. Those who follow this style invest in companies that exhibit above average growth, even if the share price appears expensive in terms of metrics such as price to earnings ratio and price to book ratio. So some famous growth investment stocks would be a lot of the tech companies now, like Tesla, AMD, Nvidia, kind of like those booming tech stocks with high PDE ratios, meaning that it's pretty expensive. It's a pretty expensive stock. So he's best known for kind of promoting this concept at a time when it was kind of foreign to people here in America. He believed that investors could earn better returns in well-managed companies in fertile fields, whose earnings and dividends could be expected to grow faster than inflation and the overall economy. So the core of his approach was proprietary research to guide investment selection and diversification to reduce risk. And it remained part of the firm's principles. So as you may know, he created T. Rowe Price, which is an investment firm that has over $1 trillion in assets under management today. So his main sticking points were obviously, like I mentioned earlier, growth investing. He also believed that markets were cyclical. So for all those macro students, the whole idea of the business cycle and the ups and downs, recessionary and expansionary periods. And he's also going against the crowd. And what I mean by that is that he didn't believe in charging commissions to traders or his clients. Instead, he believed in charging a fee on the assets. So basically, they'd only charge money if they actually performed successfully and made money. So that's where that crowd opposer comes in. He had a completely different investing philosophy and kind of business philosophy at that point to his contemporaries during that era.
Okay, so moving on to John Bogle, otherwise known as Jack Bogle, that's like his nickname. And John Bogle is known for passive investing, specifically with index funds. So Ronak and Matt were talking a lot about more like active investing typically, where you try to beat the market. But John Bogle's more known for passive investing, in which you try to mirror the market. So like if the market is doing well, then typically your portfolio will also do well. And the opposite applies. So you can see at the bottom, John Bogle's investing philosophy is to advocate for no load, low cost, low turnover, and passively managed securities. So we're going to break apart what each of these mean. Okay, so first of all, with no load, it's kind of like what Ronak was talking about just now. No load mutual funds don't require a commission. So they don't charge you an extra like sales price in order to invest in a certain stock. So for example, if you had $10,000 that you wanted to pour into an investment, all $10,000 would actually go to the investment instead of like having a cut go to your broker or your financial advisor. And you might think that this is like kind of elementary, but it's actually not. Most times you will have like part of your money go towards, unless you're on Robinhood, of course, but like you'll have part of your money goes towards like a broker. And so in this case, John Bogle said, look for things in which you don't have to pay for a commission. And so obviously all of your money would go towards the actual investment. And the opposite would be a loan fund. And so he founded the Vanguard Group, which is basically his own investment firm, in which he incorporates a lot of no-load mutual funds. Low cost is pretty intuitive. It just means that the fund or the stocks don't cost very much. Low turnover refers to the turnover rate of a portfolio. So for example, if a stock or if a specific portfolio contained stocks or funds or bonds or stocks or bonds that were traded a lot, and so their frequency of getting turned over was very high, John Bogle would say then that's too active. It's not stable enough to be a good investment. So he would advocate against that. And so the last part of this is basically passively managed. So John Bogle basically advocates for index funding or passive funding or passive investment in which you match the market index. And so as Matt said, we do advocate a lot of diversification in this club because it lowers the risk of your overall portfolio, right? Because you have like stocks in different sectors, for example, and because they're so different, then if one sector performs well another day and poorly another day, for example, with COVID, kind of like doing really well for some sectors and doing really poorly for some other sectors, then at least you gain less, but you also lose a lot less. And so John Bogle said you want to definitely diversify your portfolio, and you also want to use a buy and hold strategy, which means you want to buy into like a stock or a fund, and you want to hold it for a really long time and kind of just like wait for the market to eventually do better and for your portfolio to eventually increase in value. And lastly, he did write a book called The Little Book of Common Sense Investing. I like the name of it. And it is it's a digestible book, so I totally recommend it. You can see like Warren Buffett actually put a quote on the front of the book. And John Bogle, one quote from that book is up on the screen, which is that owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. And of course, you hear a lot of people in the news who actually do very well. They obviously beat the market, but that's like a mix of luck and skill, a lot of that being luck. So John Bogle would say, if you kind of just want to like play it a little safer, you'll have a more stable and consistent and better overall chance of doing well if you just like buy and hold for a long time. And I think that this quote really embodies his central investing philosophy.
Okay, so Warren Buffett, you will have heard of him. Like 3 people have already mentioned him. The quote that I picked out is, we simply attempt to be fearful when others are greedy and to be greedy when others are fearful. So it basically means that when others are greedy, prices tend to rise, and you should be careful that you don't overpay for an asset. And then when others are fearful, it might mean that there is a good value buying opportunity for you. He was a student of Ben Graham, who Matt already covered. He is a value investor, which means that he searches for stocks that are believed to be undervalued by the market, or stocks that are valuable but not recognized by most buyers. And his methodology is for finding low price value is to first look at the company performance, and then second, look at their debt, and then third is to look at the company's profit margin, which is how well a company uses its revenue to create profit. Fourth is to see if the company is public, because that means they're required to file regular financial statements. Fifth is their commodity reliance, like oil and gas. And then sixth, and most importantly, is it cheap? So you can determine if it's undervalued. Unlike other investors, he rebutted the efficient market hypothesis, which states that stocks always trade at their fair value, which makes it harder for investors to buy, to either buy stocks that are undervalued. For positions, he is the chairman and the CEO of Berkshire Hathaway, and his nickname is Oracle of Omaha because first, he lives in Omaha, Nebraska, and second, his investment picks and opinions are very highly valued.
Okay, next up we have George Soros, which I'm sure you guys have heard of because he's very controversial in the news, especially for politics, which we won't talk about today. We're just going to talk about him as an investor. Okay, so George Soros, first of all, his investing philosophy centers around the idea of reflexivity, which was kind of iconic in his time because it wasn't a very common philosophy to have. And so reflexivity is basically the theory that there's a feedback loop that connects investors' expectations with the actual market and economic trends. So he's saying that investors have some certain expectations and perceptions of how the company or the market is doing. And this actually causes the trends that they are seeing, which then reaffirm their beliefs and expectations. And so it's this constant loop. It's kind of like a self-fulfilling prophecy in other ways. And the idea of reflexivity is what he outlines in his essay, The General Theory of Reflexivity, which somebody will send in the chat. And it's actually not that long. It's just an essay, not a book. So I totally recommend reading it. I read a little before this meeting, and it's very digestible. And it also kind of reads like a biography because he talks about his own life and why he came to believe in the theory of reflexivity. And reflexivity is kind of rooted in sociology. It's not exactly a pure economic theory, but if you're interested in social economics, then this would basically be a good starting point, and you could go more into it in passion projects, which are coming up. Okay, so his second theory that he promulgates a lot, which would be the global macro strategy, which is exactly like what it sounds. It's kind of like a really massive one-way bet that usually involves like global security or global economies, in which he bets against things like currency rates, derivatives or commodity prices, stocks and bonds. But George Soros is most known for betting against currency rates, which is like why that's first. And the global macro strategy definitely revolves around macroeconomics and using that as like a tool for investing, which isn't actually very common because macroeconomics is very separated from finance. So George Soros, I mean, obviously he's very rich, so he kind of is able to do this, but most normal people wouldn't be able to use global macro strategy because we don't have the capital for that. Okay. And so if you've heard of him, you probably know him as the man who broke the Bank of England, which is semi-correct. It's obviously sensationalized, but it was a really big deal. So basically what he did was he bet against the pound, which, if you know, is the currency of England. And when you bet against the pound, that's obviously a very risky thing to do because it's like the government itself. So you have to be really rich and you have to be really willing to take on that kind of risk. And George Soros, he broke the Bank of England because he kind of forced the Bank of England to do something they didn't want to. And before I go into the explanation of how he did it, kind of just understand that it's really similar to the concept of short selling, which we've explained a lot of times in this club, especially with GameStop, which hopefully popularized or maybe explained the idea of short selling to people who might not know it beforehand. But basically what he did, a little context before actually we get into what he did, just a little history. So post World War II, most economies in Europe were kind of in like shatters. They were like really, really bad. And so what they did was they tried to bind together the different economies so that they would be hopefully more stable. And so what they did was obviously create the EU. And before they had the concept of the euro, which is separate from the EU, obviously, right, because the pound exists. But before they had the euro, they had this thing called the ERM, which is the exchange rate mechanism. Basically what this did was it stabilized exchange rates between different nations, and it bound together their economies. And Britain, being Britain, didn't like this because they didn't want to be bound to other economies and thus reliant on others. And so they didn't join for a really long time, but eventually joined during a recession, which is not a good idea, which you'll see in a second. But what they did was they joined in the middle of a recession. And because they were in that recession, Britain was like, okay, how do we get out of it? So one way would be to slash interest rates, because when you slash interest rates, you increase the ability to borrow, and you thus stimulate the economy, consumer spending, investment, all those good stuff. But they weren't allowed to do this because the ERM said that it would devalue the pound and thus make exchange rates way too volatile. So they actually wouldn't let the Bank of England do this. And so because they couldn't do that, they had to turn to expansionary monetary policy, which we've also explained in our Federal Reserve explanation presentation. So if you guys remember, expansionary monetary policy has a couple components, but one of the big ones, especially of late, would be open market operations, right? So like when you buy a certain, like for example, bonds in America. And so in this context, the Bank of England bought a bunch of the pound back from the public. And that was all in an effort to basically expand the economy. And so Soros knew that this couldn't go on forever, because actually the English economy kept on dipping, even though they were using expansionary monetary policy, because their inflation rates were just way too high. So it just wasn't sustainable. So what Soros did was he basically he borrowed a bunch of the pounds, and then he sold it on the foreign exchange market. And this is starting to sound a lot like short selling, right? So he borrowed and then he sold on the foreign exchange market, and he exchanged it for a bunch of German Deutschmarks. I really hope I'm pronouncing that right, but basically it's their currency. And so he knows he has to eventually buy back the pounds and like give them back, right? Because he still has those pounds on loan. And so what he did was he was hoping the exchange rate would drop so that it'd be cheaper for him to buy back the pounds. So how does he get the exchange rate to drop? Well, basically he waits for really bad news for the pound. And so what he did was, there was a rumor at the time that there's the Bundesbank. I really hope I'm pronouncing that right too. Bundesbank president, which is like this, I think, international bank. But basically he said that certain currencies were really vulnerable, including the British pound. But George Soros kind of tacked on the last part and spread this rumor throughout the financial community to make people go like, oh yeah, the pound is doing really poorly right now. And so then of course, a lot of people started selling the pounds. And so he was able to buy it back at a really low exchange rate, which is good for him, right? Because he basically sold it at this high rate, bought it back at a low rate, profited a lot. So when he bought it back, he returned it. And so he profited a lot, and a lot of taxpayers lost out. And what happened was, because so many people were selling the pound in mass, the Bank of England realized they had to increase interest rates to stop this rampant selling. And when they did that, they were basically kicked out of the ERM, which was good for them in the long run, actually, because it helped them have more flexible policy and eventually expand their economy again. So a lot of people see George Soros as a villain, but also in hindsight, kind of as a hero, because he indirectly pulled England out of the ERM, which is a bad thing for England, and helped them regain their economy. So that's all up to a matter of perspective, I guess. So some people call it Black Wednesday when this happened, and others call it White Wednesday, because a lot of people lost a lot of money. He gained like $1 million, but yeah. And if you thought this is crazy, this kind of happened over and over again, because George Soros has a lot of money and he wants to do things with this money. And so in 1997, with the Asian financial crisis, people say that when he bet against the Bank of Thailand, so the Thailand baht, which is their currency, he gained a lot of money, and he did this exact same thing in Thailand. Actually, he did the exact same thing in Japan, like in 2013. So he basically viewed this a lot. But I think in Japan, that kind of backfired on him, because I heard he lost a lot of money. So yeah, it's definitely very risky. Don't think that this is like an easy success kind of thing. And there's a lot of maneuvering that has to go on. And he definitely kind of market manipulated, I'd say. But whether that's a good or bad thing, I mean, it's in perspective, right? Okay, and so he founded the Quantum Fund, big hedge fund, and he also founded the Open Society Foundations, which is basically his philanthropic organization. So the quote up there is, "Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected." And so you can see George Soros definitely bets on the unexpected. He does not follow the trends at all. He creates the trends.
All right, so we just talked about the currency investor Soros, but now we're going to dive into a corporate raider. which is Carl Icahn. So for those of you guys that don't know, a corporate raider is essentially an investor with a lot of money that goes into a company and arranges a hostile takeover to essentially what that means is they go into the company, they buy out as many shares as possible, and then they buy enough shares so that they'll have managing control of the company, right? So then that way they're able to make as many decisions as they want, and they're able to then get rid of the previous management in the company and replace the previous management. It could be like the CEO with someone that they can have a lot of influence on. So essentially, what Carl Icahn did in the beginning of in the beginning of his career, and corporate rating isn't a term that we use that often anymore, but in the beginning of his career, he would go into companies and he would dismantle them, and he would take them over, and then he would make a profit that way, but then leave that company in shambles, or that company will eventually file bankruptcy. So one example of this was with Trans World Airlines, and this was a couple of decades past, where Carl Icahn essentially went in and bought out most of the company to get managing control. And from there, he would then replace the CEO of the company. And then what he then did was he laid off so many people and made so many pay cuts. And keep in mind, the Transworld Airlines was a airline that had labor unions. So it's not like they were completely unprotected. But after he laid out all these employees, they were at such low functioning capacity that they were only able to make such a slight profit that Carl Icahn, who was then the managing shareholder in the company, able to dismantle the airline by selling off different trade routes and selling off all of their assets to different airlines. And by selling off those routes, those airline routes, the airline no longer had any routes to actually function. And what had happened after that was Carl Icahn then was able to sell the bits and pieces of this company, completely completely bankrupting it and leaving it in no state to compete with any of the other airline industry, and then any other companies in the industry. And he made such a hefty profit from that he earned his position as a corporate raider. But nowadays we don't see this term that much because the idea of a corporate raider has shifted to the idea of activist investing. So what is activist investing? It's essentially when someone with the status and the influence as Carl Icahn goes into a company and begins investing in that company. And he usually will look for a very undervalued company. So a company that's not doing that well, maybe in a really tough industry. So he'll go in there, buy out managing control of the company. And then what will happen after that is individual investors like you and me, we would then go in and under what's been dubbed the Icahn lift, whatever Carl Icahn invests in, a lot of individual investors will follow him and then also invest in that same company, which will then, of course, lift the price of the stock. So by that default, Carl Icahn has been kind of like a hero to individual investors in modern times because he's been able to get other people a profit because he's been able to use the Icahn lift to lift up the share price. And in terms of is his nickname a pun? I don't know. So essentially, some of the other positions that he's held is he's the founder, chairman, and majority shareholder of Icahn Enterprises, which is a publicly traded company, but I think he owns like 95% of it. Also, he was the former special advisor in the Trump administration, but he resigned after there was some disagreements there. In more recent news, if you guys heard at the beginning of COVID-19, the rental car company Hertz actually filed for bankruptcy. Not sure if you guys know this, but even though they're a rental car company, Hertz also acts as a used car sales company. So they sell their used cars that they no longer rent out. And of course, the automobile industry took such a big hit during COVID because no one was going out to buy new cars, used cars, so that the price of Hertz, or the company of Hertz, filed for bankruptcy. And then Carl Icahn, who had originally invested back in 2014, he'd invested like upward of $3 billion into the company to have like a overall 35% share in the company, stake in the company. So eventually what had happened was, after they filed for bankruptcy, he had to sell at such a loss that I think he lost like $2 billion in that one company alone. So I know earlier today we've been talking about how important it is to diversify your investments into different assets, not just one company. Of course, the type of investor that Carl Icahn is, a corporate raider or activist investor, whatever term you'd like to use, is a type of investing that's extremely ballsy and really risky. And in order to make such huge gains in these different industries and these different dying companies, he has to take these type of risks. But again, this isn't a type of investing that an individual investor can get into, just because you need such a large amount of capital to be able to take managing control of these companies. Another thing in recent news is with Herbalife. So if you guys have heard about the company Herbalife, that's a dietary supplement company. They're like the top company in their industry. Essentially what had happened there was Carl Icahn squeezed. He bet. There was another investor called Bill Ackman who invested in the company, but at a short position. So when Carl Icahn knew about this, he and some other hedge fund managers went into Herbalife and they short squeezed, kind of like what happened with the GME. They short squeezed the company so that the price of the stock would go up, and that way they would make a profit, because then Bill Ackman, who had originally had a short position, needed to buy back all the stocks, which would even further boost the share value of the company. So essentially, what we need to know about Carl Icahn: he's a corporate raider. He takes he hostily takeovers companies, and he is now known as an activist investor and an investor for the people.
All right, thanks, Gordon. That was a very interesting person, and this is someone I consider even more interesting. So this is William H. Gross, and his quote here is that you need to make big bets when the odds are in your favor, not big enough to ruin you, but big enough to make a difference. So this guy is pretty much the bond king. So up to this point, we've been talking mostly about stocks, and in the case of George Soros, currency. But now we're talking about the bonds, the second biggest asset class. So the reason he's named the Bond King is because he managed one of the world's largest mutual funds, focused mostly on bonds and fixed income investments. He actually founded PIMCO, which many of you probably know, and managed PIMCO's Total Return Fund, which was once the world's largest bond fund with almost $300 billion in assets. And he was actually able to beat the market for most of his career by exploiting elements of certainty and mastering the element of uncertainty. He was for bond investors like Gross, they kind of took into consideration variables like credit ratings, yields, maturities, duration, a measure of risk. So the longer a bond's duration is, the more widely its price fluctuates when rates change. With cautious investors choosing short-term durations to limit price volatility caused by interest rate changes. So basically, the longer a bond lasts, the more volatile it'll be, and safer investors like to stay away from that because it's obviously a lot of risk contained in that volatility. So Gross actually kind of took advantage of this by making educated but accurate guesses on the direction of interest rates, inflation, and other variables that affect bonds. So there's some really interesting facts about him. For one, he actually played blackjack professionally in Las Vegas, and he said that many of his strategies in blackjack applied to many of the strategies involving spreading risk and calculating odds. He actually used those in his investment decisions, which take that as you will. And he's also a really weird guy overall. So he actually writes this monthly newsletter where he contains forecasts, but sidetracks to really weird subjects, including his disgust for public bathrooms, and I think it was like an ode to his dead cat. I believe it was. Yeah. So he was at PIMCO for a really, really, really long time, like 30, 40 years. But then he left and went to Janus Henderson, which is a fund in the UK, I believe. But then also left that recently in 2019 and now does some charitable stuff. One of his most famous investments is his investment in stamps. He thinks that stamps over time will appreciate. I don't exactly remember why he holds this philosophy, but he's really, a lot of people know him as the stamps guy. So that's where that term alternate investment comes in.
Okay, so we just went from a kind of weird guy to now one of the, in my mind, one of the greatest investors of all time, Peter Lynch. So for those of you guys don't know, Peter Lynch is the former manager of the Magellan Fund at Fidelity. And during his tenure there, over 13 years, he was able to return an average of 29.2% return on investment for 13 years in a row on average. And he's one of the most famous value investors of all time. I know we talked about that before with some of the other guys that we talked about, but the thing that he's most notable for, or one of them, is his book One Up on Wall Street, which was a extremely it was a very digestible book. It was a book that was really relatable to the average investor. And in the book, he really promoted the ideas of that an individual investor is able to have more freedom and be able to have more a greater assortment of investments than an average hedge fund manager. And what does he mean by this? Essentially, the philosophy was, if I'm working at a hedge fund, I have to meet some sort of quota. I'm really restricted to only a certain amount of stocks, maybe like a certain pool of stocks, maybe S&P 500 or some other international stocks. But with an individual investor, you have such a freedom with what you can invest in. And essentially what this allows you to do is you can invest in small cap stocks, and you can invest in less well-known stocks that aren't managed by stocks that aren't well known by the big hedge fund companies. And Peter Lynch's philosophy was really against the grain at that time. Essentially, he introduced these new ideas of the individual investor being able to recognize and see different aspects of their own lives and apply those to their portfolios and to their investments before the hedge fund managers could do that themselves. And one of his most famous quotes, invest in what you know. And another one is focus on the companies, not the stocks. So by this, he means even in your daily life, you see these are the products I'm using. These are the, maybe I use this energy company for my electricity bills. Maybe I buy this brand of soda, and maybe I am just such a big fan of this retail company. Well, what does that mean? So you can apply that into your investing through seeing what you, the consumer, likes, and then therefore using that knowledge to invest in certain companies that you think will have projected growth. And another idea that Peter Lynch came up with was GARP, or growth at reasonable price. And essentially that idea combines the fundamental ideas of growth investing with the fundamental ideas of value investing. And by doing so, it's able to measure the projected growth of a company and pit that in against the PE ratio in what's called the price to earnings growth ratio, which is another term that Peter Lynch came up with, and that places the PE ratio against the projected growth. And by that, you're able to see how valuable a stock is and how much growth potential is there. And the last thing that Peter Lynch really drove home was the idea of the 10 bagger. What is the 10 bagger? Essentially, a 10 bagger is any stock that can grow up to 10 times of your original investment. So any stock that provides a 1000% ROI. And Peter Lynch, in his book, One Up on Wall Street, he talks about how the 10 bagger, you can notice them before hedge funds get into them, because hedge funds, so in a hedge fund, if I was the manager, I have a certain quota that I have to meet, right? So I can only invest in, let's just say, well-known companies like Google or Microsoft or Apple. Now, if I wanted to invest in a smaller small cap company that only has a market cap of maybe say less than $5 billion, I'm not allowed to do that, because why? It's such a risky investment, which no other company or no other big investors has gotten into. So when you look at it like that, what can a manager at a hedge fund invest in? They can either invest in Google, and if they, let's say they lost 10% on Google, or they can invest in a no-name company and lose 10% there. Well, obviously, the higher executives at the company will say, well, if you lose 10% betting on Google, that's fine. Like, come on, that's such a well-known stock. Of course, it'll probably bounce back up, and there's so much potential there. However, if you lost 10% in a no-name company, there's definitely going to be consequences. So in that aspect, the hedge fund manager will most likely invest in the company that's more well-known. And then therefore, it leaves room for other investors, individual investors, to get into the smaller cap company and find the potential there. And Peter Lynch, some of the aspects that he uses to recognize a 10 bagger include companies that are in a very specific industry, but are the best at it. So what this means is, in an industry like tech or IT, every single company is most likely they're on an upward trend. So we all heard the term "everybody's a genius" in a bull market. However, in a bear market, that's where you know who the real geniuses are, right? So by that aspect, in an industry such as tech, where all the company values are going up, but maybe one day the market in that industry crashes. Now, what happens to everyone that has already previously invested in there? They lost all their investments. However, if you invest in the best company in an industry that's not well known, let's take a dying industry like oil, for example. If I invest in the best company in the oil industry, most likely the other companies in the oil industry will file for bankruptcy someday and become overshadowed by the best company there. Not sure if I'm making sense right now, but essentially what happens is the best company in a dying industry will take over the other companies and acquire the other companies in the same industry and become even bigger. And that's where you return your investment. So that's the type of investment that Peter Lynch focuses on. He doesn't focus on following the trend and what everyone else does. He focuses on these really specific individual strategies that individual investors are able to take advantage of, but maybe not be reflected in other hedge funds.
Okay, Abigail Johnson is a very accomplished female investor, which the world needs more of. The quote that I chose is, "Your results are very quantifiable, and nobody can take these results away from you. They're yours." All of that, I think, is very good for women. And it just talks about how your results prove your success, and which is important for women since there's not as many of them in this field. She is the CEO of Fidelity Investments since 2014. She took over after her father, and she's also a chair member of Fidelity International. She holds almost 25% stake of the firm, which is almost 3 trillion in managed assets. So she has a net worth of 50 million US dollars, which makes her one of the richest women in the world. She also supports cryptocurrencies since in 2018, Fidelity launched a platform that allows investors to trade Bitcoin and Ether. And we actually featured her on a Strategist Saturday post on our Instagram. So go check that out if you want more information.
Okay, so we've reached the end of the presentation, but we still have an activity afterward. So I know this presentation went on a little longer than expected, so I'm going to ask the crowd what you guys think we should do. Either one, we plan for the presentation or the activity now, and then we actually give mini presentations that will only take a couple minutes each at the beginning of the next meeting, which can kind of be a warm-up? Or two, do you guys just want to do everything today? Anyone can unmute or say something in the chat. And if there are no opinions, I will just decide. But if you have an opinion, please do say it. Officers, you guys can have an opinion too.
I'd be okay with doing it all today.
Okay, so the options, just a clarification. One, you plan for the activity today, which will take most of the time, although the activity isn't very long. And then you'll finish it up by presenting next week for the warm-up. Or two, we can just do everything today, like Colleen was saying. Okay, if we have no more opinions, then we're just gonna do everything today. Cool, Colleen, your way. Okay, so it's not a very complicated activity, so let me just explain it before we break out into breakout rooms. Okay, so basically you've heard about 9 different investors and they all have really cool things to say. They've obviously been successful. So what I want you guys to do now is you will go into these breakout rooms and you'll have an officer in that room. Let's take Ronak as an example, right? So let's say you get Ronak in your room. So what you can do is choose either of his 2 investors. So between William Gross and Thomas Rowe Price. And what you do is basically predict, or I'm saying some of them are dead, but think of 3 investments that they would make, right? Anything, stocks, bonds, funds, whatever. And what you would do is try to explain it. And it's really simple. It would probably just take like a 30-second explanation. And this activity hopefully will only take around 10 minutes of planning. And so there's going to be 4 different rooms. Matt, he will just take my people as well. So he's going to have Ben Graham, as well as the 2 people I did. So Bogle and Soros. So what you do is you just try to think of investments that they would make. And I would like for you guys to stray away from the investments they actually made. So don't try to like search up things that they actually did. But if you just happen to accidentally pick something that they did, that's okay as well. You just have to explain it. Let's see. Any questions? Okay, in that case, let me clarify one more time. You are just doing 1 investor, 3 investments that he or she would have made. 1 investor, okay, per room. And I'm gonna send you guys into randomized rooms, but you will have an officer in each one. Hold on. Let me stop sharing.